Welcome back to our daily discussion. I'm Tom.
And I'm Amy. We're here every day to help you get genuinely well-informed fast.
And it is Wednesday, so you know what that means. We've got our stack of sources ready, all focused on personal finance investments.
And really navigating that whole path to financial freedom, it can be tricky.
Tricky's putting it mildly. Some of the stuff we looked at today, well, it pulls in completely different directions. Some really counterintuitive advice, actually.
Yeah, on building wealth, but also, maybe more importantly, how to avoid the common money traps people fall into.
So that's our goal today, right? To sift
Yeah.
through these conflicting ideas.
Exactly. We'll look at why just saving cash might be a mistake, tackle those psychological walls we build around money, and try to make sense of the investment world from simple index funds all the way to, crypto.
The aim is for you to leave with something solid, something actionable.
Let's do it.
Okay, section 1, the guaranteed loss saving versus investing. Let's hit that big, shocking takeaway first. Our sources are saying the biggest mistake isn't picking a bad stock or something. It's just being a saver. Just letting cash pile up in the bank.
Right. And the phrase they use is guaranteed loss, which sounds harsh, but
Guaranteed.
well, it's about your money just sitting there doing nothing. It's getting weaker every single day. The technical term is currency debasement.
Which most people just call inflation.
Exactly. The government creates more money, prices for everything go up, and that dollar you saved buys less and less. You're literally getting poorer.
Okay, so that connects to this other point, what one source called one of the worst pieces of advice ever.
Oh, yeah. Which one was that?
The classic. Get a job, make money, then immediately try to get a mortgage for your house.
Ah, right. That traditional path.
Yeah.
It's surprising how much criticism that gets in these sources.
Why is it so bad, according to them?
The argument is you pour all your extra cash into this one big, expensive thing that's hard to sell quickly. Your house. And you do that before you start seriously investing. So compared to someone who prioritized compounding their money first, your future self could actually be worse off.
Interesting. So if that's what most people do wrong, what's the mindset of people who get it right?
Discipline. It really boils down to discipline and this relentless focus on compounding results, making money work for you.
It's the small things, isn't it?
Totally. Like that comparison one article made. The average American apparently spends more each month on stuff like Netflix than they actually put into their investments. Changing that one priority makes a huge difference.
And the numbers back it up. That example of investing, say, $1,000 a month.
Yeah, just $1,000 a month consistently for 30 years. Put it in something basic like an S&P 500 index fund.
And you end up with?
Around $1.9 million, give or take, based on historical averages. It's consistency, not genius stock picking, that builds that kind of wealth for most.
Okay, but that leads us straight into section 2,
Yeah.
the psychological barriers. Because knowing this stuff is one thing.
Doing it is another, absolutely.
Money is just stressful. Like the number one stressor for Americans, apparently. More than work, health, family.
It's huge. And what do we do when something feels overwhelming?
Avoid it. Push it away.
Exactly. The stat was, 82% of Americans admit they actively try not to think about their finances?
That's staggering. And the generational thing, too. Gen Z, millennials, way more likely to avoid even checking their bank balance because it's too stressful.
Yeah, 67% of Gen Z, 58% of millennials, compared to like 30% of boomers. It's worrying. We're kind of conditioning ourselves to be financially avoidant.
So if avoidance is the enemy, how do you start fighting back? What's the first practical step?
Awareness. You just have to heighten your awareness. You need to know where you actually stand.
Huh?
The simplest tip, repeated in a few sources, is just track everything. Every penny you spend for 30 days, maybe 60, maybe even 90.
Because most people have no clue.
Pretty much. 65% of Americans apparently have no real idea what they spent last month. And one anecdote mentioned people underestimating by like 60 or 70%. You can't fix a problem if you don't even know how big it is.
That makes sense. But what about those really extreme situations, like that example of a friend drowning in debt? 40 grand in loans and credit cards.
Yeah, high interest debt.
Paying maybe 800 pounds, 1,000 pounds a month just on repayments and starting to miss mortgage payments. I mean, tracking expenses feels a bit small scale then.
It is. When you're in that kind of spiral, the sources say it needs severe, extreme, and quick sacrifice. You can't just budget your way out of 25% interest rates easily.
So what does that severe sacrifice look like in practice?
You basically have to stop spending on anything that isn't absolutely essential. Everything. Ditch the subscriptions, the eating out, the coffees.
Use that freed up time and money.
To hammer the debt with the absolute highest interest rate first, that's the priority. You got to stop the bleeding,
Yeah. This leads to that really uncomfortable topic the sources touched on. Bankruptcy. There's such a stigma.
Huge stigma. But the uncomfortable truth, according to some research cited, is that avoiding it can actually be more damaging long term.
How so?
People who actually go through bankruptcy statistically often end up in a better financial spot years down the line than those who spend decades just struggling and avoiding, purely because of the shame.
Because it forces a reset.
Yeah, it forces a reset. It often imposes a kind of financial discipline and structure that maybe the person needed but couldn't implement themselves. It's a tough conversation, but it's in the data.
Okay, shifting gears a bit. Section 3, income. We've talked a lot about saving and debt, but sometimes the biggest lever you can pull is just making more money, right? Especially if you feel like you're always stretched thin.
Absolutely. I mean, getting a 10% return on $1,000 is great, but finding a way to bring in an extra $500 a month, that can genuinely change your life right now.
So how do you do that? The sources suggest focusing on what you already know.
Yeah, monetizing your uniqueness. Don't think about going back to school necessarily. Think about the skills or hobbies you already have. What have you spent hundreds, maybe thousands of hours on?
Could be anything.
Anything. Coaching a sport, playing an instrument, knowing a particular software inside out. That's expertise people will pay for. One source called it knowledge arbitrage.
Meaning?
Just selling what you know that others don't. Could be super local, like, I don't know, teaching pickleball for $30 an hour if that's your thing.
Oh, good.
Or it could be broader, like read the top 10 books on a new technology. Now you know more than 99% of people about it. Package that knowledge, sell it to businesses. That's monetizing expertise you just acquired.
And there was a strong point made about one particular skill being the most valuable.
Ah, sales.
They called it the single best skill you can acquire.
Because sales is basically just persuasion. Right. And you use persuasion everywhere. Getting a raise, convincing employees, raising money for a business. If you can sell, you can create opportunities. It's a huge lever.
And connecting back to that mindset difference,
Yeah.
it comes down to delaying gratification again.
It's the fundamental split. Wealthy people tend to save and invest first, then spend what's left over. Most people spend first, and then hope there's something left to save.
You have to flip the script.
You have to flip the script, pay yourself first, meaning your investment accounts, then figure out how to live on the rest.
All right, section 4, the investment landscape. So you've got your income flowing, you're saving first. Now what do you actually invest in? The sources broke it down into roughly 3 paths.
Yeah, first is the completely hands-off way. Hire a financial advisor.
Sounds easy. What's the catch?
Cost. It's the high-cost option. That typical, say, 1.5% annual fee doesn't sound like much.
But it adds up.
Massively. Over 30 years, that fee could easily eat up like $600,000 of your potential returns. It's a huge drag.
Wow. Okay, so option 2, the one recommended for almost everyone.
Passive investing. Just buying low-cost index funds. The classic example is an S&P 500 fund, which just tracks the biggest 500 companies in the U.S.
And the returns.
Historically, it averages around 10% a year. The beauty is it's low effort, and the evidence is overwhelming. These simple passive funds beat something like 90% of professional active money managers over 20 years.
They beat the pros.
Consistently. It's kind of humbling for the pros, actually.
Yeah. So the third way is trying to be one of those pros yourself. Active investing.
Right. Trying to beat the market by picking individual stocks or timing trades or finding specific assets.
Higher potential reward.
Potentially, yeah. If you average, say, 13% instead of 10%, that difference over 30 years is huge. We're talking maybe $3.5 million versus $1.9 million in that earlier example. But it takes a ton of time, a ton of research, a ton of skill, and frankly, a bit of luck. The odds are heavily stacked against you. The consensus from these sources was really clear, like 98% of people should just stick with passive investing.
Okay, let's talk about the really high-risk stuff then. Bitcoin, crypto. The argument there is that you need that higher potential return because money itself is losing value so fast, right? That debasement issue again.
That's the core argument. Proponents will say, look, no asset in history has created wealth as fast as Bitcoin. They cite figures like 145% average annual return since 2012.
Which is insane.
It is. And for someone young with decades ahead of them, maybe not much capital to start with, you could argue that taking that kind of risk makes mathematical sense. They have less to lose, more time to recover.
But the volatility is terrifying. Drawdowns of 70% or more. How does a normal person stomach that?
That's the crux of it. The biggest risk isn't usually the asset itself, it's you. It's your own emotions.
Panic selling.
Exactly. Seeing your investment drop 70% and bailing out, locking in that loss, instead of having the conviction or just the discipline to hold on for potentially years until it recovers. If you can't handle that psychological roller coaster, it's probably not the right path for you. Temperament is key.
What about ways to earn from crypto without the intense trading? Staking came up.
Yeah. Staking, especially with something established like Ethereum, is interesting. You basically lock up your coins to help run and secure the network, and you earn a yield for doing that, maybe around 4% currently.
Like earning interest.
Sort of, yeah. Think of it like providing collateral for the system. It's lower risk than trading. But remember, the value of the coins you've staked can still go up or down a lot. You're still exposed to the currency's volatility.
Got it. We also need to talk about passive income. That phrase gets thrown around a lot, especially with real estate.
Yeah, the sources really challenged that idea. True passive income, where you do literally nothing, either needs a massive amount of capital upfront or you're taking on significant hidden risks.
And real estate isn't truly passive.
Definitely not. One source called it the least passive income you can imagine. Tenants, repairs, vacancies, admin. It's often a very active business.
Okay. And what about just owning your own home? Is that an investment?
The argument in these sources is primarily no. It's mostly an expense, especially in the beginning. It's the way mortgages are structured. On a typical 30-year loan, for the first, say, 15 or 20 years, the vast majority of your monthly payment isn't actually paying down the loan.
It's going to the bank.
It's going straight to the bank as interest. You're essentially paying a very high rent to the bank for most of the loan's life before you start building any significant equity, any real ownership. It's not the wealth builder people often think it is compared to other investments.
That's sobering. And speaking of long-term, the final big issue, retirement. The numbers are pretty stark. The average baby boomer heading into retirement with maybe $200,000 saved.
Yeah, it's often just not enough, given how long people live now and rising costs. And it highlights a misunderstanding about things like Social Security or state pensions.
That's so.
People think they're paying into their own personal retirement pot, but that's not how it works. Your contributions today aren't saved for you. They're used to pay current retirees.
Oh, it relies on enough workers playing in.
Exactly. And the demographic trend, fewer younger workers supporting a growing number of older retirees, puts huge structural pressure on these systems. That's why you constantly hear proposals to find money elsewhere, like taxing investment gains more, or even assets like Bitcoin to plug the future funding gaps.
Okay, Section 5. Final takeaways. Wrapping all this up, there's a clear theme about managing emotion, isn't there? From debt panic to investment FOMO or fear.
It's the absolute core principle, yeah. You mentioned that famous line that kept popping up?
About the best performing brokerage accounts.
Yeah, they belong to dead people.
Morbid, but why?
Because they can't mess with them. They can't react emotionally to market swings or scary headlines. They can't panic sell. They can't chase hype.
So success comes from taking yourself out of the equation.
Pretty much. It's about setting up a system that forces you to be disciplined, that removes the need for constant decision-making. That's why things like dollar cost averaging work so well.
Explain that quickly.
You just commit to investing the same fixed amount, say $500 every single month, automatically. Doesn't matter if the market is high or low, you just buy. It averages out your purchase price over time and, crucially, stops you from trying to guess the perfect time to buy or sell, which is usually driven by fear or greed. You take emotion out.
Okay, so if we had to boil down all this advice, some of it quite challenging, into just a few key takeaways for someone listening right now, what would they be?
Okay, I think 4 main things stand out.
Educate yourself. You absolutely have to know your baseline income, spending, and understand the basics, like how inflation erodes savings and how interest works both for you and against you.
Right, knowledge first.
2, invest above all else. Don't let large amounts of cash just sit there losing value. Remember that guaranteed loss. Make investing your default.
Get it working.
3, start now. Don't wait. Don't wait for the perfect time or until you have a big lump sum. Time in the market is way more important than trying to time the market. Even small amounts, started early, make a huge difference thanks to compounding.
Just begin.
And 4, invest in your network. Surround yourself with people who are also aiming higher, who talk about opportunities, who push you to think bigger about your income and your finances. Your environment matters.
Educate, invest, start now, network. Got it. That's a fantastic synthesis of some complex ideas. Thank you for breaking that all down.
My pleasure. It's crucial stuff.
Oh,
And hopefully helpful. Join us again tomorrow, everyone.
yes. Tomorrow is Thursday, and as always on Thursdays, we'll be looking at some important figures who really changed the world in significant ways.
Should be fascinating.
Absolutely. In the meantime, please do hit that subscribe button on the channel so you don't miss any of our daily conversations. Thanks for tuning in today.
See you tomorrow.